Welcome to the live online class of Dr. B.R. Ambedkar University. This class is the 5th semester and the course name is Income Tax 1. In the first class, you have seen the basic concepts of income. Who is an SSC? What are the types of SSCs? What is agricultural income and how is agricultural income treated under the Income Tax Act and certain other things. In today's class, we are going to talk about the residential status of an individual. Now, what is the meaning of residential status and why is residential status very important? The questions which we need to answer here is number one. Does residential status differ from year to year? Who has to prove the residential status? And who are the persons who have to prove their residential status? And what is the effect of this on their tax liability? So first, the question that we posed to ourselves was, will this residential status differ from year to year? The answer is yes. Residential status will differ from year to year depending upon the movement of the SSC from within the country and outside the country. By default, every person is treated as resident and ordinary resident. If the person leaves India during the current previous year and does not stay in the country, he has to prove that he is not a resident and ordinary resident. Otherwise, it is assumed that he is a resident and ordinary resident individual. Okay, so on what does the residential status depend on? Before we look at on what does the residential status depend on, we will understand that a person under the Income Tax Act is classified as resident and ordinary resident, known as OR. Second, resident and not ordinary resident. He is called NOR. And third is non-resident. That is NR, non-resident. In order to treat a person as any one of these three categories, certain rules are laid down under the Income Tax Act under Section 6, subsection 2 of the Income Tax Act. Now, Section 6 states the number of days a person is present in India. If a person is present in India for a period of 182 days or more during the relevant previous year, he is treated as resident individual. When a person stays within India during the relevant previous year for a period of 182 days or more during the previous year, he is treated as resident. Where a person does not stay for a period of more than 182 days, then there is the second condition, the second test that has to be applied. See, for a person to be treated as resident or non-resident, there are two sets of conditions. The first set of conditions are called basic conditions. Basic conditions are A and B. Basic condition A is stay in India for a period of 182 days or more. If a person does not satisfy the first basic condition, that is A, then you have to test the second basic condition called B. Now, the second basic condition says, if it does not stay for 182 days, then you have to see whether he is staying for 60 days or more during the previous year and 365 days or more during the 4 years preceding the previous year, 4 years before the previous year. If he satisfies this second basic condition, B, he will be treated as resident. Okay. Now I will unmute the participants who have joined. In case they have got any doubt, they can ask me. They can ask me in the chat box. I will explain them again to you in case you have got any doubt. Okay. So for those students who have joined just now, we are looking at the residential status of individuals, and we said that an individual is classified into three. One, resident and ordinary resident, called OR. Second, resident but not ordinary resident. Third, non-resident. Okay. Now, for a person to be called as resident and ordinary resident, there are two conditions called as basic conditions. If he satisfies any one of these two, he will be resident. If it does not satisfy, he will be non-resident. What are those two conditions? Condition A, stay in India for a period of 182 days or more during the previous year. If it does not satisfy A, then look at B. B says, if he stays for more than 60 days during the previous year and 365 days or more during the 4 years preceding the previous year, he has satisfied the second basic condition. He will be called resident. Where a person does not satisfy any of these two conditions, either A or B, he will be called non-resident. Okay, so we have seen the two extremes. One is resident, the other is non-resident. For a resident, he has to satisfy either A or B. If it does not satisfy, he is called non-resident. Now, a resident individual is further classified as ordinary resident, not ordinary resident. To call an individual ordinary resident or not ordinary resident, there are other sets of conditions called additional conditions. They are called additional conditions. Additional conditions are two. Number one, he has to be a resident for at least 2 years out of the 10 years preceding the previous year. He has to be a resident for at least 2 years out of the 10 years preceding the relevant previous year. Second additional condition, he has to stay in India for a period of 730 days or more during the 7 years preceding the previous year. This is the second additional condition, where an individual who is treated as resident further satisfies both the additional conditions 1 and 2, he is called resident and ordinary resident. Where an individual who has satisfied basic condition either A or B, or both A and B, he is called as resident. But if it does not satisfy the additional conditions or satisfies only one additional condition, he is called not ordinary resident. He is called not ordinary resident. Where a person does not satisfy any of the basic conditions, he is called non-resident. Okay. Now here, why are we trying to classify individuals as resident, non-resident, not ordinary resident, ordinary resident? Why are we classifying? We are classifying in order to determine his taxable income, on what incomes he has to pay tax. On what incomes he has to pay tax. Where a person is treated as resident and ordinary resident, he has to pay tax on both Indian incomes and foreign incomes. While a person who is treated as non-resident will pay tax only on Indian income. Now, what is the meaning of Indian income and foreign? Indian income means any income which is earned in India, arises in India, accrues in India, and received in India is called Indian income. Where an income is earned outside, accrues outside, and is received outside, such an income is called foreign income. Where a person is non-resident, he will not pay tax on his foreign income. He will pay tax only on Indian income. Then what about this not ordinary resident? We said an ordinary resident will pay tax on both Indian and foreign, while a non-resident will pay tax only on Indian. You have got the middle category, that is not ordinary resident. This not ordinary resident individual will generally pay tax on Indian income only. But however, if he has got income from a business that is outside India, but controlled from India, he will pay tax on that income also. Where he has got a business that is established outside India, controlled from India, such income also. This is about the residential status and incidence of tax. Okay. The meaning of incidence is on whom is the tax levied? Who is liable to pay tax? So where you have got both Indian and foreign income, you will pay tax if you are an ordinary resident. Where you are a non-resident, you will pay tax only on Indian income. If you have got an income from a business that is established outside India but controlled from India, you will pay tax on that income also. Okay. Now this is very important from the examination point of view. You know that in your exams, you will get one theory question. You cannot escape from that theory question, that is compulsory. Now that theory question, most probably, in all likelihood, you have a choice in it. This particular topic, determination of residential status of individual, is very important and it is very likely to appear in your exams. Okay. Now a person is classified as individual or HUF or firm or company, cooperative society, artificial juridical person. Okay, this you might have studied in your first class. In the first class, when you were talking about person, you might have been explained, you might have been told that a person is any one of these individual, Hindu undivided family, partnership firm, association of persons, company, cooperative society, artificial juridical body. Now we have talked about the residential status of individual. Even all the other persons also will have residential status. For a HUF, you have to look at the movement of the Karta from India and outside India. When we are talking about the period of 182 days or 60 days, it means you are staying within the geographical limits of the country. The day of departure and the day of entry into the country is determined as being in the country. So the Karta's movement has to be seen. If the Karta satisfies both their basic conditions, the HUF is called a ordinary resident. If the Karta satisfies any one of the basic condition and only one or none of the additional conditions, the HUF is treated as resident but not ordinary resident. If the Karta does not satisfy any of the basic conditions, either A or B, then the HUF will be treated as non-resident. Now here quickly, dear students, I want you to take a pen and paper, because see, these are your online classes. They are as good as your offline classes. So have a pen and paper in front of you. Write down whatever you feel is important. I will just give you. Do you want me to give you, or we'll just go with the explanation? Can anybody raise their hand? I will unmute them. Zakir Ali, are you there? Zakir Ali, please unmute yourself. Zakir Ali, are you able to unmute yourself?
Hello. Hello, good morning.
Yeah, Zakir Ali.
Yes, sir.
Yeah, are you able to understand what I'm trying to tell you here?
Just now I reached to my place, sir. While I was in the lift.
Okay, okay. Is there anybody who was there right from the beginning? I think Neha Fatima was there right from the beginning. Neha, can you unmute yourself, Neha? Okay, we'll go ahead. Assuming that you have understood whatever I was trying to tell you, we'll just go ahead to the next topic. The next topic that I wanted to cover in this class is income from salary. Income from salary. See, an individual will earn income in different ways. Suppose I am there. I earn income from my university. Okay, I earn income. I get salary from my university. Suppose I have a house property and I give the house property on rent to different individuals. I will get income by way of rent from the houses. Suppose in one of those houses, I have established a small business. Okay. Or suppose assume that I do some consultancy services. I provide consultancy services to individuals who want to file their income tax returns. I get some income from profession. I get some income from business. Suppose I have got one agricultural land and I have sold off this agricultural land and I get some profit out of it. I said I get some gain out of it. That also is my income. Suppose I have purchased some shares from a company and that company is declaring dividends. I get dividends as income. Suppose I purchase a lottery ticket and I win the lottery. I get income by way of lottery also. If you look at the various examples that I have given, in all these examples, I am getting income. But the source from which I am getting the income is different. In the first case, I get income from the university where I am working. In the second case, I get income by way of rent from the house that I have constructed. In the third case, I get income from the small business that I have established or the small professional services that I give. I get some fees out of it. That also is my income. I sold off one land and I got income from there. That also is my income. I get dividends from shares. I get lottery income. All these are incomes, but the source is different. Depending upon the source of my income, depending upon from where I get my income, the income under the Income Tax Act is classified into 5 different subheads. They are called subheads. The first subhead is income from salary. The second subhead is called income from house property. The third one is called income from business or profession. The fourth is called income from capital gains. And the fifth one is called income from other sources. These are called the heads of income. They are called the heads of income. And under each head, there are different sets of rules that govern the computation of that income. Suppose I get income from salary. From section 15 to section 17, those rules of computing the income from salary are laid down. If I get income from house property, then from section 23, 24, 25, and 26 are the sections that deal with income from house property. Section 56 deals with income from business. Section 54 deals with income from capital gains. Like that, there are different sections that are laid down, and under each of the section, under each of the head, there are different rules that will help you compute the tax liability. In today's class, we will talk about the first head of income, which is called income from salary. First, we will define what is salary. Salary is any amount paid by a person called as the employer to a person known as the employee under a contract of employment. Any amount paid by a person known as the employer to a person known as the employee under a contract of employment in recognition of services provided. In recognition of services provided, whatever income you get is termed as salary. Okay. Now, this salary that you get will again have different components. I will get basic pay. I will get bonus. I may get commission. I may get leave encashment. After retirement, I will get pension. I will get dearness allowance. I will get house rent allowance. I will get lunch allowance, academic allowance. I will get a free house for me to live in. The employer will pay the rent. That is called rent-free accommodation. there are different ways in which salary is paid to me. So remember, consciously I have used the examples that I gave you. I said I will get basic pay, I will get bonus, I will get leave encashment, I will get advance salary, I will have contribution to my Provident Fund, I will have commission. All these are grouped together under the subhead salary. Within salary, within the income from salary, again there are subheads. The first subhead is the salary that I get. Then the second subhead is allowances. The second subhead is allowances. Allowance is any monetary benefit paid by the employer for a specific purpose. Any monetary amount, any money paid by the employer to the employee for a specific purpose is called allowance. Allowances are not same in all the organizations. For example, uniform allowance is there. Uniform allowance is given to employees whose job requires them to wear a uniform. For example, the postal employees, employees working in the APSRTC, employees working in some public sector organization like say BHEL. Those employees, they have to have a specific uniform. Okay. Now they are given uniform allowance. So this allowance is given for the purpose of their expenditure which they incur on purchasing the uniform. House rent allowance is there. House rent allowance is given to pay the rent of the house in which you are living. Children education allowance is given. Children education allowance is given for the fees of your children, school fee of your children. Hostel allowance is given. City compensatory allowance is given. For the employees who are living in cities, they will have some additional expenditure. For that, CCA, City Compensatory Allowance is given. Dearness allowance, the main allowance is dearness allowance, DA. DA is given to compensate the high cost of living. The cost of living will change from year to year. What is available for you for 10 rupees today will be available say for 12 rupees tomorrow. The extra 2 rupees is the high cost of living which can be linked to the inflation. In order to offset, in order to counter inflation, you are given this allowance called dearness allowance. Okay, so like this, the difference between salary and allowance is salary is paid for all the employees, while allowance is paid only to specific employees for a specific purpose. Okay, suppose you do not live in a rented accommodation, you own a house. You are not given HRA. Even if you are given HRA, you cannot claim any deduction or any exemption from HRA. Suppose there is one allowance called high altitude allowance. Employees who work in high altitudes, they are given one allowance called high altitude allowance. Tribal area allowance, hilly area allowance. It is not given to all. It is given only to employees who work in hilly areas, who work in high altitude areas. Okay, so like this. And allowances can be withdrawn by the employee. They can be withdrawn by the employer, while salary cannot be withdrawn. Okay, that is salary and allowances. Then the third one I told you was I am given a house. I do not pay any rent of the house. I just live in the house. The employer will pay the rent. Here, no monetary benefit or no money is given to me. But the employer will pay my obligation on my behalf. Suppose I am given a mobile phone. The employer will pay the whatever is the recharge, the employer will do the recharge for it. If it is postpaid, the employer will pay the bill for it. Here what is happening is, whatever obligation I have, the employer is meeting that obligation on my behalf. It is known as perquisite, perk in short. It is known as a perquisite. Okay, perquisites are any kind of benefit given in kind, not in cash. Any kind of benefit provided by the employer to the employee, not in cash but in kind, is known as perquisite. Then in addition to perquisites, you have got profits in lieu of salary. Profits in place of salary. That is, say, keyman's compensation paid by the employer to the employer. It comes under profits in lieu of salary. Okay. Now here I have told you 4 components within salary. The first component is called salary. Under salary, you have basic pay, bonus, commission, employer contribution to Provident Fund, arrears of salary, advance salary, commission, leave encashment, pension. All these will come under the subhead salary. Then the second subhead is allowances. Allowances, as I told you, are any kind of monetary benefit paid by the employer for a specific purpose to the employee. They are dearness allowance, city compensatory allowance, children education allowance, hostel allowance, academic research allowance, uniform allowance. Okay, city like this, you have got different kinds of allowances. Then the third one is perquisite, profits in lieu of salary is the fourth. Okay. Now, first we have talked about the first subhead called as salary. When you take salary plus allowances plus perquisites plus profits in lieu, that total is called gross salary. The total is called gross salary. From the gross salary, you have deductions under section 16. Under section 16, there are 3 deductions from gross salary. Number 1, standard deduction or statutory deduction. Number 2, exempted entertainment allowance. Exempted entertainment allowance. Number 3, professional tax paid. Okay, so from the gross salary, under section 16, there are 3 deductions given. 16.1, standard deduction or statutory deduction, which is a fixed amount of 50,000 rupees. A fixed amount of 50,000 is given as standard deduction under section 16.1. Then 16.2, exempted entertainment allowance. Exempted entertainment allowance. Now, what is the meaning of entertainment allowance? Why is it given? And who can claim exemption? Any allowance paid by the employer to the employee for entertaining the guests of the business is called as entertainment allowance. It is not for the personal entertainment of the employee. It is, suppose, say for example, I am an employee and I am the director of the company. Usually, visitors will come to me. I have to offer them some soft drinks. I have to offer them some snacks. They are the visitors who came to me, not in my personal capacity. They came to me because I am the director, and there's a direct relation between why they are there and my employment. So when I spend something on them, the employer has to give me, because I didn't do it for my own purpose. That allowance is called entertainment allowance. Now, entertainment allowance is a fully taxable allowance. And under section 16(2), deduction will be given. That deduction is any out of these following three, whichever is less is deduction under section 16(2). 1, 1/5 of basic pay. 2, actual allowance received. And 3, fixed allowance of rupees 5,000 per annum. Out of these three, whichever is less is given as exemption under 16(2). Under the subhead allowance, the entire allowance received has to be put. And under 16(2), whatever exemption is available has to be given under 16(2) from the gross salary. This allowance is given as a deduction only to government employees. It is not given to non-government employees. It is given only to government employees. Okay. So we were talking about allowances under section 16. 16(1) we said was standard deduction, which is a fixed amount of 50,000. 16(2) is exempted entertainment allowance, which is least of 1/5 of salary, actual allowance received, and fixed of rupees 5,000 per annum. And 16(3) is professional tax paid. Any professional tax that I pay on my profession is given as deduction under section 16(3). So from the gross salary, when I give deductions under section 16, what I get is called income from salary. What I get is called income from salary. This entire computation will form your second block. Okay, I think you have your material with you, and in that material, if you see, you have got block 2. Rather, this is block 3. I'm sorry. Block 1 is the concepts which your Arun Kumar sir has covered in the previous class. Now, because Arun Kumar sir has got some other commitment, I am taking the second class. The third class onwards, again, Arun Kumar sir only will come. I am only substituting for him only for today. The second block I have covered in this class only. We talked about residential status and incidence of tax. That was block 2. Then block 3, exemptions and salaries. In that you have got exclusions, salaries 1 and salaries 2. So I am covering that block 3 now. Okay, currently I am covering block 3. And in this block 3, we have talked about salaries. And in this salaries, the entire block 3 consists of computation of income from salary. So definitely in your examinations, you will get one problem regarding exemptions or one question regarding exemptions. Another question regarding salary. Okay, this is a short question in your examination. Compute income from salary of Mr. X from the following details given, from the information given to you. He will give you bits and pieces. He will give you some items that we talked about under salary. He'll give you some items which come under allowances. He'll give you some perquisites, and he'll give you some profits in view. You have to take all these under the statement. Under subhead salary, list out the items that come. Under allowances, list out the items that come. Under perquisites, the items, and a total of all this is called gross salary. From gross salary, give deductions under section 16. What you get is called income from salary. This is the entire block. Okay. Now, whatever is important under the subheads, that I will now tell you. I've just given you an overview of what to expect in block 3. Okay. Now we will discuss the items under each of the subhead in detail. Okay, we'll discuss the items in each of the subheads in detail. Okay. I have got one message in the chat box that says that the voice is not coming properly. Can you speak louder? Is my voice not clear? Can anybody tell me my voice, is it not clear? Okay, I'll try to speak louder. Or I'll do one thing, I'll switch off the fan. Okay, now I think I have switched off the fan. Now probably my voice would be kind of clear. We'll just assume. So under the subhead salary, the items that come, they do not need much explanations. Take the items straight away as they come. Only the one thing that requires explanation is employer contribution to Provident Fund. Employer contribution to Provident Fund. Here we will understand what is the meaning of Provident Fund, what is the treatment of employer's contribution to it, and certain other issues related to this particular item. Provident Fund, as the name itself suggests, any fund that is created to meet unforeseen circumstances is called as a Provident Fund. A fund that is created for in case you have any unforeseen expenditure, some sudden expenditure, then you can use this fund. Usually, employer will contribute a part of your salary to this fund called as Provident Fund. You as an employee, you will also contribute a part of your salary to this fund. Together on the employer and employee's contribution, you will get interest. In case you have got certain emergency, you can withdraw from this fund in future. Voluntarily, you can withdraw for 2 things. 1, construction of a house. 2, marriage of your children. For this, voluntarily you can withdraw. In case you have got any other unforeseen expenditure, like say some medical issues, then also you can withdraw from this fund. Now, Provident funds are of 4 types. 1, statutory Provident Fund called SPF. 2, recognized Provident Fund called as RPF. 3rd, unrecognized Provident Fund called as URPF. And 4th, public Provident Fund called as PPF. To all these kinds of funds, Provident funds, the employer will contribute, employee will contribute. Together on both these contributions, you will get interest that the fund pays. Employer contribution to the Provident Fund is income. Employee contribution to the Provident Fund is saving. interest credited to the Provident Fund is again income. Okay. So when the employer contributes to a statutory Provident Fund, even though it is your income, it is not taxable. It is exempted from tax. Here we are talking about an exemption that is given for the employee for who has been contributed to the Provident Fund by the employer. The fund is created in your name. The employer has contributed to the Provident Fund in your name. Okay. If it is a statutory Provident Fund, then it is completely exempted from tax. Then your own contribution to statutory Provident Fund is a qualified saving. Now, what is the meaning of qualified saving? See, suppose I have some income. Say I have got an income of 20,000. Now, out of this 20,000, I save 5,000 every month. This is my saving. Okay. This 5,000 is my saving. Now, this saving, I can either put it in the bank, or I can just keep the cash in my almirah in my house, or I can purchase a national savings certificate, or I can purchase a post office term deposit. I can deposit in the post office. See, look at the saving that I have got. It is my saving. 5,000 is my saving. Now, this saving, I have just kept this amount in my almirah, in my house. Even though it is a saving, it is not qualified saving. If I purchase national saving certificates, it is called qualified saving. Qualified saving means any saving that qualifies for deduction under Section 80C of the Income Tax Act. Okay, the government, the Income Tax Act, in order to channelize the savings into the economy, in order to bring the saving into the economy, it says that if you have got a saving and you purchase national saving certificates, you deposit in the post office, you purchase some indemnity bonds, you purchase the electricity bonds, then your saving will come into the economy. When your savings come into the economy, it will help the country grow. So, in order to induce you, in order to motivate you to get your saving into the economy, the government will give you an incentive saying that if you, with your saving amount, purchase the national saving certificate, you will be given exemption from your total income under Section 80C. If you purchase a rural electrification bonds, if you purchase national defense certificates, okay, if you deposit in the post office, then all these savings are known as qualified savings. If you keep them in your house, they don't come into the economy. They are no doubt your savings, but they are not eligible for deduction under Section 80C. Okay. So we were talking about the employer contribution to the Provident Fund. We said it is an income, and that income is exempted from tax. When you as an employee contribute to that Provident Fund, it is called as a qualified saving. And you get interest on both your contribution and the employer contribution is what I told you. That interest that you get, even though it is your income, it is exempted from tax. It is exempted from tax as long as the fund that to which you are contributing is a statutory Provident Fund, SPF. Then the second type of Provident Fund I told you was RPF, Recognized Provident Fund, RPF. Recognized Provident Fund is a Provident Fund that is recognized by the Income Tax Department. That is called RPF. When the employer contributes to the recognized Provident Fund, up to 12% of salary is exempted. Remaining is taxable. Up to 12% of salary is exempted. Remaining is taxable. When you as an employee contribute to this Provident Fund, it is a qualified saving. It is a qualified saving. Then interest that you receive on the Provident Fund, the interest that you receive on the Provident Fund up to 9.5% is exempted, remaining is taxable. Compare this with the Statutory Provident Fund. Under Statutory Provident Fund, whatever is the contribution is exempted from tax. Whatever is the employee contribution is a qualified saving. Whatever interest is credited to that fund is exempted from tax. But when it is a recognized Provident Fund, up to 12% of the employer contribution is exempted, remaining is taxable. Interest up to 9.5% is exempted, remaining is taxable. Then the third one is the Unrecognized Provident Fund, URPF. Unrecognized Provident Fund is a fund that is not recognized by the Income Tax Department. Okay. So when the Income Tax Department does not recognize the Provident Fund, when the employer contributes, it is ignored. When the employee contributes, it is ignored. When the interest is credited, it is ignored. Ignored does not mean that it is not taxable. When any amount is withdrawn from this fund, then it becomes taxable. But if you withdraw any fund from your SPF, not taxable. Withdraw any fund from RPF, not taxable. But when you withdraw any fund, any amount from your URPF, it becomes taxable. Then coming to the Public Provident Fund, PPF. A Provident Fund that is run by the State Bank of India, SBI, for the benefit of small marginal businessmen, artisans, self-employed people. If they want to save, they can save in this fund called as Public Provident Fund. It is open to all. While Statutory Provident Fund is open only to government employees. Recognized Provident Fund is open to only the employees working in that particular organization. URPF is open to employees working in that organization which contributes to this URPF. While PPF, an employer can contribute, or you yourself as a self-employed individual, as an artisan, as a businessman, as a shopkeeper, as a daily wager, as a member of the general public, you can contribute to this Public Provident Fund. The treatment of employer contribution is that it is fully exempted from tax, provided the minimum amount contributed is 500, maximum amount that can qualify is 70,000. So where the employee contributes, minimum 500, maximum 70,000 will be called as qualified saving for the employee. Employer, any amount is exempted from tax. Then interest that you receive on PPF is completely exempted from tax. Okay, so these are the only two things that require explanation under the subhead salary. Then coming to the second subhead called as allowances. Allowances are of three types. One, fully taxable allowance. Two, fully tax-free allowance. Three, partly taxable allowance. Okay, one is fully taxable, fully tax-free, partly taxable. What is the meaning of fully taxable allowances? That is, every part of the allowance that is received has to be taxed. It is not exempted. Then what is fully tax-free? An allowance received by the judges of High Court and Supreme Court, allowances received by the diplomatic staff working in foreign consulates, allowances received by MLAs or MPs, they are called fully tax-free allowances. Now here the allowance itself is not tax-free. It depends upon the person who is receiving it. If dearness allowance or compensatory allowance or any allowance is received by the judge of a Supreme Court or High Court, it is not taxable. But if it is received by you and me, it becomes fully taxable. So here, the allowance per se is not taxable, but the person who is receiving it, for that person, it becomes taxable. Okay. So fully taxable, no problem. Take the entire thing in the statement. Fully tax-free, no problem. Just ignore it completely because it is tax-free. Partly taxable. Here, the problem will arise. Partly taxable means the entire allowance that you received is not taxed. A part of it is tax-free. A part of it is taxable. That is the meaning of partly taxable allowance. The allowance that you receive, a part of it is taxable, a part of it is tax-free. So what you have to do is, in the working note, you have to calculate that part of allowance which is taxable. Take only the taxable portion into the income statement. So outside this statement, calculate the taxable portion of the allowance. Take only the taxable portion into the statement where you compute the income from salary. So in order to find out what portion is taxable, what portion is tax-free, there are different sets of rules. So you'll have to understand those sets of rules before you proceed further. Okay. Now I think that the time is almost over. We have got only 2 more minutes. Now in these 2 minutes, I would want the participants to ask me any doubts if they have got. I have given the rights for you to unmute yourself. Please ask me any doubts if you have got. We have got Sai Vivek, Neha Sheikh, Neha Fatima, Sharda, and Priya, and one other person with an iPhone in the class. He doesn't want to give his name. So these are the people. If you have got any doubts, please ask me. Otherwise, I'm going to end the class.
No doubt, sir.
No doubt, Sharda? Okay, thank you.
Sir, till now you have told about the theoretical part only, no, sir?
No. This salary that I told you is not theoretical. I just explained to you the provisions. Okay. When we take up a problem, in that problem, you will be given the amount of dearness allowance, for example. You will be given the basic salary. You will be given advance salary. You will be given the employer contributes 15% to RPF, like that you will be given. So when you're given employer contributes 15%, I told you the theoretical part. In the working note, you have to calculate the employer contribution 15% less exempted. How much is exempted? 12% is exempted. So from the amount received, deduct the amount exempted, balance you take in this statement. Okay. Residential status was completely theoretical. But when I started salary, I gave you the outline of what is taxable, what part of it is taxable, and things like that. We still have to discuss allowances. So after we discuss allowances and perquisites, then we will take up one problem and we'll solve that problem so that you will understand how the everything has to be put in place.
Sir, so these 5%, 12% are the provisions to be used in the problem, sir?
Correct. There's no 5%, there's 12% exempted. What was 5%? 9.5% it was. Income interest was 9.5%. And employer contribution to RPF up to 12% was exempt. Okay. So shall I say goodbye for now?
Yes, sir.
Okay. Do you know who was the person who was taking your class up till now? My name is Dr. Rabindranath Solomon. I am the head of Department of Commerce, B.R. Ambedkar Open University.
Sir, previous class was taken by Harita ma'am, sir.
Yes, Harita ma'am. Okay. Harita ma'am has taken your class. From the next class onwards, Harita madam only will come because we had some internal adjustment. Ma'am had to take up some other class because some other faculty was not coming. That's the reason why I had to take your class. But then I will tell Harita madam up till what I have covered. The balance she will cover for you.
Okay.
Okay. And another important thing that I wanted to tell you all gentlemen is that on Monday at 4 o'clock, we are having one webinar. Now, this webinar is on the topic career opportunities for commerce and management graduates. Okay, career opportunities for commerce and management graduates, where Professor Rajashekar from Hyderabad Central University is going to talk to you all and tell you what are the career opportunities after your BCom. Okay, what you can do after BCom, what are the various options that are available to you, and certain other things. Okay, so I would want you all to participate. I will do one thing in the chat box. I will paste the link. Okay, you please copy the code. You copy the employee, the meeting ID and the password and the passcode, and do join this webinar. Okay. Just give me 1 minute. I'm giving the link to you. You please take this link.
Sir, link was forwarded through messages from official Ambedkar University, sir. Sir, but link was not opening, sir.
No, link will open only on Monday. No, this is on Monday. Okay, the link will open only on Monday.
Okay, sir. Okay.
Do join on this link. You will have Dr. Rajshekar from Hyderabad Central University who will give you the various career options that are available to you. And please share this link with all your other friends also so that maximum people can take advantage of this particular webinar.
Okay, sir.
Just write down the meeting ID and passcode. I will give you 2 minutes and after that I will leave the meeting. Because I think once I leave the meeting, the chat box also will close. So just write down the meeting ID and the passcode. Okay. So thank you, everybody. The next class, I think you will have cost accounting. Okay, as your next class. In case you do not have the cost accounting, then you please join in the Telugu cost accounting class, because your Arun Kumar sir, I think, has got, who takes cost accounting for you? Hello. So I want you all to join cost accounting in Telugu medium, because sir is not, sir has got some prior commitment. Okay. So thank you. I'm leaving the meeting. Thank you.
Thank you so much, sir.